Hello, everyone. Good morning, good afternoon, good evening, depending on where you are dialing in from. My name is Dapo. I'm a startup partner at Paystack. Paystack is a payment company. We provide payment APIs, developer tools, business tools for businesses of different sizes to accept and disburse payments in Africa, essentially. So we are live and operational in 5 African markets, in Kenya, South Africa, Ghana, Cote d'Ivoire, Nigeria, right? So the Paystack Startup Programs team was conceived about 20 months ago to engage and enable startups by helping to find solutions to some of the most common challenges that they face. So when you think of the challenges that startups face, you think about preparing applications for accelerator programs. You think about fundraising, you think about advice and mentorship, access to tooling, and every other thing in between. So we do all of this via the Paystack Catalyst initiative. So Paystack Catalyst is just a fancy catch-all phrase that Toba coined that refers to the different programs that we've set in motion to support startups. So think about the Investor Connect program, the Paystack Startup Bundle, the Accelerator Application Review, the compliance support, geo-expansion support, and everything in between. So on why we care so much about startups at Paystack, right? We believe that startups are the reason why we are where we have to be, right, as a business. And we think it's in our interest that startups continue to thrive and succeed. And secondly, we believe that startups help us innovate better. So you can take for granted that the product feature request that you get from startups is usually an indicator of where the market is tending towards. So we take startups very, very seriously at Paystack. So if you're out there wondering how you can get a piece of Paystack Catalyst action, well, if you're an active Paystack user and with a little bit of venture funding, then I think you're already in the club. Just drop us a line at startups@paystack.com to engage us further. So now I'm just going to pass the mic back to Toba so that we can get to the business of the day.
Sorry, I did not unmute myself. I apologize. Yes, thank you very much, Dapo. And yeah, super excited. We're going to, as I said, jump into it very shortly. We already have a few questions come in. Thank you, Christopher and Mo. Yeah, and also Darlington, thank you very much. Once we get started properly, we're going to start responding to your questions. As I said, once again, for those of you just joining, welcome. This is the Paystack Catalyst webinar. My name is Toba. Jaco just introduced what Paystack Catalyst is, and I've also given us a brief overview of what to expect today. But for the benefit of those who have just joined us, we have our panelists ready. We're going to ask them a few questions that we've prepared. And then we're going to throw the door open to a few questions from you. Now, if you want to ask us any questions, please use the Ask a New Question feature. If you see a question that resonates with you, that someone else has already asked, you can just go in there and, click the thumbs up or like the thing that makes it go up. So when you click that, the more you click it or the more people click like +1 to a question, the higher it ranks and the easier it is for us to answer. Fantastic. I see that people are already taking advantage of that. All right, without further ado, I'm going to hand off to the man, the myth, the legend. Ladies and gentlemen, put your hands together for the man, Mr. Nubi K. Woohoo! All right. Nubi is going to pop up now as I kick off that ball.
Hi, everyone. Can you guys hear me?
Yes, loud and clear.
Awesome. Thanks so much, everyone, for joining. Thank you, Dapo, for just shedding light on what Paystack Catalyst is. We're excited to get as many people, engage with as many people as possible. And so, like you mentioned, startups have so many challenges, funding being one of them. And so we just said, let's bring people who who can actually like speak to this and actually answer as many questions as possible on the mind of people who have perhaps raised the first check and think about their next round or about to raise their first check. And so my name is Nubi. I lead the startup programs at Paystack, and I'll be joined on panel with 3 early stage investors who will be joining me on stage now. So first we have Eunice Ajim, we have Dayo, and we have Yewande Odumosu. So can I just bring them up, and then we get the show on the road.
Yeah, sorry to interrupt, Nubi. Just one quick input here. Hey folks, we've also put up a poll. We want to know how Paystack Catalyst can help you. So while we're bringing our guests, our panelists up on stage, please just take a moment to go in there and click whichever one, vote for your preferred method that Paystack Catalyst can help you. We'll be putting up more polls as the event goes along. So please, Nubi will also let you know when we do. So please interact with them. And okay, over to you, sir.
All right, thank you so much. Yeah, I see the result already coming in, and surprise, funding is seems to be on top of the list by about 70-something%. So I'm glad we're actually tackling the topic in this conversation. So let's just jump into it. Guys, just in one line, can you just introduce yourself, your name, and what you do? Dayo, want to go first?
Sure. My name is Dayo. I'm one of the partners at Microtraction, an early stage venture capital firm that invests in African tech companies at the very earliest stages of their business. I'm really glad to be here.
Awesome. And where are you dialing in from?
Currently dialing in from London, actually.
Okay, I'm going to start with that question. Okay, next person, Yewande. Hi.
Hi, everyone. My name is Yewande Odumosu. I'm the managing partner of HoaQ Ventures Fund. We're an early stage fund investing in tech startups in Africa or focusing on the diaspora. I am currently dialing in from US.
All right, thank you, Yewande. And last but not least, Eunice.
Yeah, definitely. My name is Eunice, and I'm the founding partner at Ajim Capital. Very similar to Dayo and Yewande. I'm an early stage VC fund investing across sub-Saharan Africa. And I'm dialing in from Austin, Texas.
All right. So we have 3 early stage investors. Early stage, very particular because again, we're talking about like that first check or that next check. It gets, I would say, a little bit easier as you go because again, it's about like proving your worth to largest or later stage of growth stage investors. But that early stage, that initial ramp is often very challenging. So getting that early stage investor connection right, I think is very important. They're also set in different locations as well. So I think don't be limited as to where you go looking for investors. Be very open-minded as to where your investors might be seated and just see how you can work in your network to get to them. So we'll look at that later today, but let's just jump into the first set of questions. Let's set the record straight because again, people are saying it's a bear market, it's hard out there, there's no money, everybody's holding their fists tight, but dry powder. So many narratives out there, but let me just make it clear. Are investors still writing checks? And when I say are investors, are you still writing checks? And if so, when was the last check you wrote?
Happy to go first. Yes, we're still writing checks. We're still in the market of looking for impressive founders, great companies. And the last time we wrote a check was in June this year. Okay,
that's 2 months ago. All right. How about you, Eunice? Investors writing check? And if so, when was the last check you wrote?
I definitely think that the market is, I'm not even going to sugarcoat it, like the market is definitely hard right now, no matter what anybody says. I think if you're based out of the US, you know that there's a recession going on, or a potential recession, if I may say this, inflation, interest are going up. There's so many crazy things. And when those happens, a lot of investors hold their money because they don't know what is going to happen in the next 6 to 12 to 24 months. I personally am still writing checks, but I have significantly reduced the number of checks I've written this year versus last year. And the last check that I wrote was in April.
Okay, so 1 April, 1 June, people are still writing checks, slowing down, but still writing checks. How about you, Yewande?
Yeah, similar with Dayo and Eunice. I'd say that there's definitely a slowdown, like if we're being honest, and investors are more critical now to where they're deploying capital. You know, a lot of people have learned over the last 2, 3, 4, 5 years, and yes, there's definitely a slowdown, but people are still writing checks. I'm fortunate to answer that I wrote my last check yesterday, so yeah.
Okay. All
It's
right.
just a coincidence, but yeah, the last check we wrote was yesterday, actually. But
All
but it
right.
took a long time, so it's compared to last year. It's not like, oh, it took a long time, but the most recent was yesterday.
All right. So it's taking a long time, but again, people are still writing checks. So I'm glad at least everybody on this call has written a check this year. So at least it's not a matter of like I'm bringing people to come talk about things that they're not actually doing or practicing. So thank you so much. By the way, I didn't know the answers to these questions before I asked them. So this was just me taking a shot in the dark. But I'm glad you guys are actively investing. So that's good. There's a saying, we back people, not ideas. I mean, we hear that a lot. Oh, it's about the team, it's about the people, ideas change and stuff like. But I want to just hear how true this is. How true is this statement to you and your fund in particular? On a scale of 1, not so true, to 10, absolute truth. When again that statement says we back people, not ideas. Who wants to go first?
I think mine is a combination of both. We definitely back the founder at the end of the day, but the idea still matters, right? You could be a great founder working on a shitty idea, and that probably won't go anywhere. But we'll always weight the founder's experience more than the idea versus a great idea and a really poor team.
Okay, I'm going to press you on that. What is your split then? Is it 80-20? 80 founder, 20 idea, 50-50, 60-40? What's that split for you?
I'll probably say 70% founder, 30% idea.
Okay, Dayo?
Yeah, I think it's both of them, because you need both.
I'm taking diplomatic answers.
No. I'm gonna give you my percentage split, but I think both are very, very important. Founders more important because it's just pretty early. Like it's there's a whole lot that happens after investing, right? So founders, I would say, would be about 80, 75, 80, then idea. The idea, as long as you like the idea and it makes sense, the founder has to be really, really good for it. So yeah.
So 70 or 85, 15 or 70, 30. Okay. How about you, Yewande?
I think fortunately for me, I'm with like really great people on the panel, but I think I'd agree with Dayo. I think the only thing different for me or for us is the founder is or the set of founders is very, very important. The idea actually comes from the founder. So, and that's based on the founder's experience, have they validated the problem? And that also shows you the kind of founders they are. So yes, we may not necessarily know the founder when we hear about the idea, but even that is a subset of how the founder thinks, how the founder processes, how the founder has experienced this problem. So it would definitely be like a 75-25, because whether we like it or not, the idea is even also part of the founder's expression into the world. So, for me, it's almost the same thing. So it's both. But yes, there are times when founders start with a specific idea, and then we have to figure out if we believe that this founder or this set of founders will quickly iterate, will quickly pivot if it's not working, and would understand what will really, really adapt to their current realities. I think that's the only difference. And that's where the founder is even much more important. Can this person or can this set of people really learn so fast, or how long will it take to like iterate? That's where you now start seeing founders are more important than the idea.
All right, awesome. So let's jump into the first segment of our conversation, how to win investors. Many founders might be mistaken to think it all starts with the pitch, like when I send you my pitch deck. But I think we could bust that myth today, and I think that stems from one of Eunice's Twitter thread around the importance of relationship building with investors. So for you guys, like when we say build relationship with investors, what does that mean? How does that manifest prior to here's a deck? I want some money. Yeah, Dayo.
Sure. I think there are different ways to get to an investor, right? I don't want people to feel like you have to always build a relationship first. Like, I mean, because if you're waiting for that, it might be difficult sometimes for some people to actually build relationships, and that shouldn't stop you from actually still getting investments, right? Obviously, from an investor point of view, a relationship is better because you're not just investing in a company, you're investing in people, right? And you want to kind of understand the people that are behind the company. But I think as a founder, and I've been a founder before, I think the best way to kind of get a hold of investors is to find them wherever they are, is to show that you have something meaningful to actually, present to them. And is to also look for people that know those people as well, right? I think those things are pretty key, because one, as we would probably allude to later in the webinar, is referrals play a huge role in how investors actually make investments, right? And so if I was a founder again today, I would go for events that I think would get me closer to a particular investor that I'm interested in. I would make friends with, the junior colleagues of the particular investor that I'm looking to get investments.
So pretty much walk the network,
walk the network. Create some form of, obviously have something to present, because you don't want to create a network or build a network and you have nothing to show for it, right? But I think the key thing is to just, the long and short of this is try and look for different ways, and don't think that there's only one way to a particular investor. There are different ways, and you just have to be very innovative and creative in how you find investors as well.
Yeah. Eunice, you started this trade, so I'm curious to hear your thoughts on this. Like, have you seen interesting ways in which people have actually come across? I mean, you've come across deals. So, like, other than the here's my pitch deck, back me. Like, what other ways have you seen founders work their way to you?
Yeah, definitely. And I think I share obviously a lot of content on the internet about that. And Nubi told us to give very short answers, and I'm struggling to give short answers. So I think for me, I'll say probably one of the best ways. I mean, obviously, like, I think Microtraction have a place on their website where you can apply. Ajim Capital has the same. At the end of the day, like, those places are still the best ways. Obviously, like 80% of the investment we've made to date were applications on our website, and about 20% were referrals from other investors. So when we talk about building relationship, I think like people for example, I'll give you one of the best advice I can probably give right now, given that I have a short amount of time. I would say, if you have the heart, if you feel comfortable being a public figure, start sharing a lot more about your journey on the internet. And what I mean by that is, if you have a healthcare startup, for example, right? Share the behind the scenes, share exactly the problem that you're pursuing. Like, constantly put a lot of information that is actually educated to your customers, educated to investors, and educated to potential employees on what exactly you're doing. I think that is a great way to be able to like reach a broader network of investors than to individually try and build this relationship.
Interesting.
If you want me to build, if you want me to explain other ways to build a relationship, maybe you have to give me a few more minutes.
Consult. Okay. All right. I think we'll have a masterclass one-on-one with everybody later. But I definitely hear you on that. I think it was Gary Vaynerchuk that said every business is a media business, and that's because, like, again, so the content you put out there is doing multiple jobs, from acquisition to investor relations to hiring. Like, it does there's a lot of value to actually make that investment in just putting content out there. And I think on that same topic of content, that I'm curious to hear about from you, Yewande. You're a social media celebrity, if you will. And so, like, is that how does one like tread that line of like, I'm putting out content for these purposes, and actually getting the return on investment of that content? Because it takes time to also do that. Like, it's time that could be spent building your venture as well. And say, okay, I'm actually going to be doing this. So, like, is it worth it? Like, is it worth spending that much time? And how does one actually go do that in the right way without making any missteps?
Okay. Yeah, I think it's number one is very, very worth it. Especially when I think the biggest difference is, are you putting out substance? Are you putting out things that have depth? Like Eunice said, if you're showing behind the scenes, are you educating your customers? Are you like, it has to be educative, it has to be informative, it shouldn't just be noise. Stick with what is consistent for you. So if it's once a week that you're going to post substance, do it once a week. If it's once a day, do it. There's no pressure to like, oh, I have to like be always in front of the internet. But if you can consistently put out things that people find interesting, educative, truthful and honest. So a lot of people come online and they embellish and they say, oh, we've done XYZ transactions. Investors sometimes are not very forgiving, because once you have integrity issues, and investors talk, investors know a lot of people, investors know founders, investors know advisors. And once, it's detected that you're full of, a lot of lies, it's going to just be very, very easy. So make sure that it's honest, no matter how small. And it's also good for you because you're also building your journey. Investors know that as a startup, you're building your journey. And so they want to be able to see, oh, I got my first customer, to I now have 10 customers, to, oh, I applied to YC and I got rejected, but then I applied to Techstars and I got accepted. Those kind of things in private and public also show your journey. You may think that they are not watching or they are not listening, but also when they hear of you and they go check. So that's another thing they love do. A lot of investors do research online. They go to your LinkedIn, they go to your Twitter. Sometimes you would have gone to be abusing people and be partaking in some funny things, and investors see it, and that's what people don't understand. So you'll be wondering why they didn't respond to you. So for me, just live your life, but just be very honest about it. Put out content consistently on your own pace, and then just see the universe work for you.
Yep. We had a YC webinar last, I think it was earlier this year, and that was like the takeaway team, like, don't lie. Like, I think it was this founder who applied to YC 7 times and they finally got in. And right there on the call with Michael Siebold, it was like, oh, we have this WhatsApp group with this, and as Michael was like, okay, here's my number, add me to the WhatsApp group. Like, just imagine there was no WhatsApp group. Like,
I remember, and I will say, I remember a founder talking to one of my partners, and he was saying, "Oh, we use this pay, we process this payment, and every time." My partner was like, "Okay, can you show me? Open it." Like, investors can ask you anything. Oh, my customers process. Okay, show me right there and then you start to stutter, and then you've just blown the opportunity. So yes, I agree that you should be very, very honest.
Yeah, integrity is really key. Now before we move to our next section, I have this question to ask. I think many people might have this on their mind, like, oh, I've gone to Microtraction's portfolio, I've gone to HoaQ, or gone to Ajim Capital, and there's a startup doing something similar to what I'm doing. Is there any point actually going to go pitch to this startup, this VC? So, question for you, point blank, no, like, sweet talk. Do you back competing startups? Yes, no, why?
Do you want me to go first?
Yeah, sure.
Okay, let me go first. So, do we back competitive startup? I'll say honestly, it depends, because I think no. Let me tell you why. If you're doing a startup that the competition is out there, we're interested in knowing what your differentiation is. Do you get? You may think that you're doing the same thing, or you might end up. We're actually still interested in knowing. Okay, because even for you even need to know your differentiation. So you woke up today and you said you wanted to do another XYZ startup. Like, we want to be convinced that you also are going to play in the lane. So yes, we will listen to you.
Yeah, yeah, I hear you, but you're differentiator, but like, you're telling me as well that I've bet.
If it's exactly the same thing, if it's exactly the same thing, we will struggle. We will actually struggle. But
but even if it's not the same thing, even though this new startup is better, doesn't that make the VC look like they've just backed the wrong horse here, and then take that information and go and tell their portfolio company that, oh, this is one way you can actually like do it better. It's like
we don't do that. We don't share those kind of information. We try to be very, very ethical. We're very, very ethical, and we'll disclose. So that's why we put our portfolio companies out there. That's why we'll tell you at the beginning of the call, and that's why we're very, very transparent. So I don't know about other firms, and I think everybody here is almost similar. We're very, very transparent, and we're very. For example, you'd see, and sorry that I'll use YC. You see YC will back like 2 payments. There's a reason they do that. But for us, we're not going to close the door just automatically. If we feel like it's the same thing, maybe, and we don't see any other compelling reasons, fine. But we're not going to think of someone better and then use that information for someone else. No, we don't do that.
Okay, so if you're back in the same company, though, let's move on to maybe Dayo. If you're back in the same companies, does that mean that you're now betting on two horses in the race and hoping that the market is big enough for two, or like hoping that one will win, one will lose? Like, is it an edging thing? And that's me again, assuming you back competing startups.
Yeah, no, look, no two startups are exactly the same. That's what you have to remember. I know it's hard for founders to accept that because, they're on the other side of the table. As investors, we're also on the other side of the table, right? And so no two startups are the same. And even back to YC's point as well, I doubt they would back the same type of company in the same batch, right? They would back the same type of company in different batches. And that's possible because, companies are different. The strategy is always different. The go-to-market strategy is different. The types of customers are different. Things evolve over a period of time. Have we backed competing businesses? Yes, but in different markets, right? And so that could be your reason for backing this market. And when you do research on markets, there's some markets where not one winner takes all. Multiple winners actually take all, right? And sometimes it's just that the winner in East Africa would be different from the winner in West Africa. And there would be no one true winner for the whole sub-Saharan Africa, right? So as a fund, you have to decide and know exactly why you're backing a particular company. And for us as well, we're very transparent and very honest. When I get on calls with competing business, no matter how small or how big the difference is, I'm forced to put my hands up and say, hey, we have a company that we've invested in. Do you want to continue this conversation? Because I'm not signing any NDA or anything, because I'm not ready to give you whatever you're telling me to anybody else. It doesn't help anybody, because at the end of the day, each founder decides exactly how they want to operate their businesses. So I think that the long and short of this is founders need to remember that they need to focus on their business, right? And that's the key thing. The more you focus and think about the rest of the people playing in the same field, the more distracted you are, and you're not getting a lot of stuff done, right?
Okay. I guess the spirit of the question is just to see that, again, people are not stopping themselves approaching when they see a competing startup in the portfolio.
No, absolutely. I think you should approach any investor as long as they are aligned with what you're trying to do. So don't go and approach a fintech investor when you're doing supply chain. Don't go approach a logistic investor when you're doing health. That's a different ballgame. But if there's an investor that you think would invest in your company, even with a competing business, go. Your strategy might just be different. And that's what the investor is looking out for.
Okay. Eunice, any thoughts on that before we move on to the next segment?
I think my idea is very similar to Dayo. I've invested in a couple of, I'll just give like a very simple example. So many cross-border payments out there, and I've invested in probably 3 or 4. Every single one of them are doing really good. So,
okay.
Yeah.
So like large enough market for multiple players to excel in.
Exactly.
Okay. Awesome. Cool. Let's go to the next section, which is about the pitch deck. So now we've talked about the importance of like working relationships. So go to events, explore degree of separation. So if you know someone who knows somebody and all, also just again direct as well. Like Ajim said, 80% of their deals has been people writing in direct to their website, which is very interesting. So please, there are many parts of the market, like the Yoruba adage goes. So please try all of those ways to build relationship. But then now the pitch deck. Now it protects in front of you. A lot of people have like stated data, 10 seconds and it's gone, and they move on to the next one, or the first 3 slides and then it's gone. Like, so let's talk about the pitch deck. Pitch deck usually features a few things: problem, solution, size of opportunity, traction, team, go-to-market strategy, funding request, and use of funds. That's typically like the framework of most pitch decks. So just curious on you guys, number of slides, any optimal number of slides for you guys that you think works?
8 to 12.
8 to 12. Any other answers?
Yeah, anything above 10 is too much. Yeah.
Okay, 8 to 12, 10. Sweet spot for you, Yewande?
I mean, 10 is average. If you see yourself doing 15, anything above 15 is a disaster.
Okay. So 8 is the lower end, 15 is the higher end, 10 is the sweet spot. Okay, everybody, please go trim your decks if it's outside of those. Okay, and then other of things we've mentioned that, but then what matters to you, like out of all the things I've mentioned? So again, problem solution, sales opportunity, traction, team, go to market, funding requests, and it's like, what are the, like, maybe not the one thing, but the 3 things, if there are any 3 slides that would have, like, okay, just spend more time sharpening this, making this at least crystal clear. What would those slides be for you guys?
I'll say for me, like first thing I always look at the problems, like do I fully understand these problems? And then I look at a solution, like does the solution make sense for the problem that I'm trying to solve? And right after that, as soon as I understand the problem and the solution, I go right to the traction. I'm like, what have you done, right? Like how many customers do you have? How much money have you generated? And then from there, I'm like, okay, who's behind this? So I look for the team slide. Like what do people back in this? Do I have prior experience in the industry that's solving, or are they prior founders? And I think usually those are like the 4 things that I'm like, okay, bang, bang, bang. And if I can fully understand like what problem and solution you're solving, the team, and then you have something to prove for what you've done, I'm more interested in exploring other sides of the slide.
Okay. Any contrasting answer to that, or are we all on the same page?
Aligned. I just want to add something to that as well. When you do this year in, year out, you kind of know what you're looking for, right? And sometimes you see an idea and you have you in your head, you're like, oh, this sounds interesting. And the next thing you go to without even trying anything is to see the attraction. You've not even checked the team at all, right? And I think it's different. It's on a case-by-case basis, but I'm aligned with Eunice on the mode of operation and what you look out for. But on different cases as well, it might just be the team. You see an idea and you just move straight to the team. Like, I want to know the team behind this idea because this is a terrific idea, right? And you just need the team to be solid. The team is not solid, traction is going to be trash, right? And so it's important to know that those key things, the problem is interesting enough. And I always say this is very important for founders. If you don't know the problem enough, you can't find a solution for it. Like you have to understand the problem so well, then because solution doesn't end. Like you keep solving for that problem till you get big enough, right? It's always, you keep learning about the solution, but the problem, you need to know enough about the problem for you to be able to solve that solution. So those slides are very important. The traction slide is very important. How you make money is also very important. And I say this, like the whole 10 slides are super important. Like they're all important in their own different rights.
Okay. Anything to add, Yewande?
Yeah, I think the only thing I would add is obviously problem and solution is like number 1 for me, because when you see a lot of problems, you just know if this thing makes sense. But I think one hack that a lot of founders don't do is the market opportunity. Now, for me, the market opportunity is one of my most interesting slides because it shows me your visioning. VCs want to back people that have vision and can see something. So if Bill Gates can say, oh, I want to have every home in the world have a PC in their home, and I can already see that vision, it's easy for me to key into if that problem and solution fits into this vision and get me excited. A lot of people don't take advantage of the market opportunity to show me how big this thing can go. Because in my mind, I'm like, okay, you're still early, but if everything goes well, how big can this thing go? So for me, market opportunity is where, like, if you can hack the market opportunity slide, then it shows me everything strategic that you're trying to do. And then it shows me if, there's a fit with like that long-term journey. So for me, that's just like one slide that I think that a lot of people don't pay attention to. And then they put all sorts of figures that don't make sense. But then that opportunity is there for you to actually sell your vision, based on the market you're working on.
Yeah, that's a spot on. I will plug a resource from actually your outlet, HoaQ, on market sizing, and that was an interview between myself and DFS Labs, help me with his name now.
Steven,
yes. Yeah. So market sizing is very interesting art. I think it's, yes, don't lie, don't make up stuff, but you could actually show your reasoning and thinking as to like how you're thinking about the market. And I think that resource is actually a good one to check out. I think flying doctor as well. Dr. Ola Brown also wrote a blog post about like market sizing as well, particularly for Nigeria. But I think it's definitely a worthy resource checking out. So do check that out.
Add something very quickly. I want to also say, like, your pitch deck is a fraction of your company, right? Like it should be presented enough to pique my interest, and that's it. Like, I want to have a conversation with you. It should be enough for me to say, hey, I want to speak to this team. And when I speak to you, it's a different ball game entirely, right? Like, you're going deeper into each of these different slides. And I think that is also very key. Be very concise, be very clear, and don't lie. It's not going to help. Yeah, it's not going to help.
Awesome. Okay. So time is running out. This is again one word answers to this. The team slides. So what makes for a great team? I know you mentioned again industry expertise and all, but how do you guys feel about the whole solo versus like having a co-founder? Where do you guys sit on that? Solo founders versus co-founder.
Yeah. So I believe in multiple founders, right? That's what I believe in. And the reason why I believe in that is it's just very hard to be a solo founder. That's just it, number one, right? Number two is you don't have all the skills, and that's why you have a co-founder. I'm a business person and I have a technical person, or I am a operator and I have some background in finance. Like, there's always meant to be complementary skills, and I don't think there's just one person that has all of that. And we are very biased to technical co-founders as well, because we believe strongly if you're building a technical business, you have to have a technical co-founder, because it's better for you to build internally than to outsource. And so I am pro co-founders, but there are always exceptions to the rule, because we have backed single founders as well. But for us, the rule is co-founders. The exception is solo.
Okay. All right. Any contrasting or agreement?
I have. I personally don't think you need to have co-founders. I think you can be great and build $1 billion business as a solo founder. We've seen quite a few out there. I think for me, I think the similar way, I think some investors put so much emphasis on the co-founder thing. I also think sometimes one of the biggest reasons, companies fail is because of co-founder breakups. So don't just go out there and find a co-founder just for the heck of having a co-founder. I think it's super important to, if you have to get a co-founder, it has to be somebody that you're marrying for the next 10 to 15 years. And if you don't think that's the kind of relationship you're going to have with that person, go about your company alone, but hire a really good executive team that can fill in the gap of a co-founder and give them enough shares that, they feel like, they're part of the company.
The owners. Okay. Yewande, thoughts on that?
I think it's really, really hard to be a solo founder. That's one of, like, building a startup is already hard. Then being a solo founder is like really, really hard. But that doesn't mean that you can't have unique advantages. You can be a very resourceful person. You may have, some unique things that are happening for you. A lot of investors don't want you, especially at the early stage, to use, to not be very resourceful and scrappy. And that's why sometimes they advise you to get a co-founder. A lot of founders that are doing tech startups are always, or most times, leaning towards tech. But there's the sales side of things, there's the business side of things, there's the finance side of things. And unfortunately, people just don't have those skills. And if you need to hire for those skills, it takes another level of resources, attracting. But if you have a co-founder, and like Eunice said, just don't go and have a co-founder for having a co-founder's sake, because it's true, a lot of co-founder breakups are really rampant, but it's just really hard. So if you're going to be a solo founder, you also have to be able to demonstrate your own uniqueness. And like Dayo said, it's going to be an exception actually, because it's really, really hard. It's really hard.
I mean, I think having a co-founder and having a great co-founder is a lot of I think it's a big milestone on the founder's journey itself. I think spending the right time of investment, and I know YC Startup School, people become co-founders that they go to college with, so you go to university with somebody and you just get to meet them there. There's that. I mean, that it's I mean, it's there's luck there as well. There's luck involved, but I think it's just a make or break. It could be a make or break as well. But still talking about investors, and there's a slide at the end of every pitch deck. I'm raising X for ABC. People always sometimes just put an arbitrary number, 500K, 250K. It's like just put a number and then see how it goes. What are your thoughts on that? Like, how should funders be requesting funding, like funding amounts, especially like factoring this climate that we're in? And also, like, how do you guys weigh that slide for most people? Like, do you actually question why 500K, why not 250K? I'm just curious of that, because this is the crust or the outcome of things. I want to get money, I want to go build. So just curious to hear your thoughts on that before we close.
Okay, I can go first. But yes, we actually ask, and then the figure that you put there, like Dayo said, your pitch deck is actually like a snapshot of your strategy. That's what a lot of people don't know. And so, whatever you put there shows me if your strategy is aligned. So if I see like a ridiculous figure and your strategy is telling me that you are still talking to customers and you have a wait list, and I'm just like, what exactly are you using the money for? But yes, we do ask. It's part of the strategy. It shows if you're raising too much, if you actually know what you're doing. And then if you write the use of funds, it also helps, because if you're going to just blast money on marketing thinking that you're going to acquire your first set of customers, that's already a red flag. So yes, just to keep the answer short, that slide is also very important. Stating the use of funds is very important, and we always ask, because it's part of the plan, and obviously
some founders don't know what amount to ask for. Like, what is too much, what is too little? Like, how do they want to settle on what they should ask for as well? Like,
I think I'd answer, but let me let Dayo and Eunice answer as well. It doesn't feel like I'm just talking.
No, I think people, there's always comparisons, right? Like you when you want to go to a YC or you want to raise money from a Microtraction or Ajim Capital or any of these companies, right? Some of them tell you how much their minimum check size is, right? And so you can, we don't know this, but sometimes people would use that as a guide to how much I need, to raise money. When people went into YC back in the day, 150 was just enough, and you just ask for 150, and that's it, right? Whether you needed that much money or not didn't matter. You just needed the money, right? But I think over time, and especially in this market as well, you have to be very clear on what you want to use the money for. You want to build a team, how much you want to invest, and they're all going to be estimates, by the way. It doesn't have to be exact. I don't think there is. I know there's a thing about saying there's you don't need to raise too much money, but I mean, it's always good to have a little bit more money than you actually need, because that buffer is very, very important. However, I think just being very clear from the onset on the things you want to spend money on, give good estimates of each of these things. And if you give me an exact number, then I want to believe that you've done some homework with your financials, because that means you're basically telling me what you need based off of your financial model, right? And I'm not expecting your financial model to be perfect. One thing I would say is this: nothing you would put on your deck, except maybe your experience as a founder, is going to be perfect. And so that's not what
you're not picking at it. Okay.
Yeah, that's not what's going to make me invest. What will make me invest is, do you understand exactly what you're trying to do? Have you thought about the risk? Oh, you're building a very big company, but you're asking for 200,000. Is that what you should be asking for? Maybe you should be asking for more. And that's what I'll quiz you on if I'm having a conversation with you. But it stems from your financial model, and that's what would determine how much you actually need.
Okay. And last question on this, please, Eunice, you can answer this for me. So people ask for money, but then they ask at evaluation. I think, again, how VC works is that I'm asking for this value, and so I will build it to be more valuable, and then you can get returns. So evaluation is somewhat important for you when people are asking for money. But then people are also just setting these numbers almost like abstract as well. Like 10 million. And then back in the day, it used to be like fintech, deck, idea stage, 10 million. Like, there's no even no processing involved. Just that's the default, less than 10 million. So just curious on your thoughts on that. That's again landing on the valuation side of things for asking money. How should founders be thinking about that element of asking?
Yeah, I mean, I think like valuation is such an interesting topic, and the reason why it's that way is because there's no right or wrong answer when it comes to valuation. I think for me, a rule of thumb is on average, me personally, I don't like to invest more than 5x, on average what your revenue looks like. Right. But again, that might be different depending on like the founder's experience, their connections, and how much their biggest investor is willing to buy into the company. I think a lot of the times founders come in at like, I'm raising 2 million at a $50 million valuation. I'm like, oh, who is your lead investor? Like, who gave you that $50 million valuation? And they're like, no, that's what we decided we wanted to value ourselves. And I'm like, no, like, at the end of the day, like, it's not you determining how much your valuation is, it's your investors determining how much they're willing to buy your company. And if you have nothing to show for why you're valuing yourself that high, I mean, and if you're talking about 5x, it means that you should be making about 3 million in annual revenue, right? For you to be valuing yourself at $15 million valuation. And if that's not the case, but your lead investor is willing to give you that valuation, then that's understandable, but you can't be the one determining that valuation. So again, like, there's no right or wrong answer when it comes to valuation, but for me personally, I would say as a founder, analyze like, okay, maybe my revenue is only 1 million, right? But here's XYZ, why I think I should be valued at this much. And another thing that I just want to mention from the founder perspective, because I've been a founder, the higher you value yourself, the more you dilute your company, especially at the earliest stage. You don't want to get to the stage that by the time you're getting to Series B, C, and D, you're owning less than 10% of your company. So also keeping that in mind when you're going out and fundraising.
All right. Thank you so much, guys. We'll open up to question now. So let's just see. Do you have any questions? We will pick the top most voted ones. And if not, we can just always come back to close out with beyond the check. So what are your expectations? We'll close out with that question. What are your expectations for founders once you've written a check? How do you leverage that relationship? How can founders leverage that relationship that they have with investors who have actually backed them as they build their ventures? But let's see, do you have any questions? Let's see if we have questions. I'm going to order by the most voted one. So we have Darlington Oyemaki. It says, how do you maintain investor relationship before you're actually about to raise? I think we answered that. So work your network, learn about them, see who their portfolio companies are they aligned to your strategy and your sector? So just reach out to them, go to events, and also I think that's one way.
Sorry, can I just add some? Can I say something very quickly?
Yes.
So the face of a VC fund is probably, for Microtraction, is probably myself. For Ajim is Eunice. For HoaQ is Yewande. And founders always feel like if they don't get access to Dayo, they can't get access to Microtraction. That is a big lie. The best person to actually speak to is the analysts and associates on the team. They are like always the first point of contact. So don't wait till you get a chance to speak to a Yewande before you approach HoaQ. In fact, you're likely to reach an analyst or associate in Ajim Capital before you get to reach out to Eunice, right? And if you're friends and very good friends with that person has all the world to actually convince Eunice to actually take a look at this. So that's something I think a lot of founders, I want to speak to Dayo. Dayo is not going to have that same time that the analyst has, because they're speaking to founders every single day, right? And so use that as a strategy as well. Look for the analysts and associates in particular teams, befriend them, and find a way to get into those companies.
Yeah. So and I think those people become like internal advocates for you as well, because again, they are the ones selling and even telling Eunice, oh, I like them because of XYZ reason. I learned about them. So again, just work the network, and that's very good advice. We have another question here. At what stage should a startup start looking for funds, and how do you go about it? So I guess is there like a time when it starts good? You say, okay, now is the time to actually start looking at funding. And what would those parameters be?
I'll go for this one. I think on average, I think the biggest mistakes a lot of founders do is that they go out to raise funding without ever going out and actually looking for customers. So I personally think that when you have an idea and you're trying to build a startup, you need to go out there and find your customers and speak to them and get them to buy your product before ever approaching investors. The unfortunate truth is that a lot of founders, when they see the announcement about founders going out there and raising 2, 10, 50 million with just an idea, they think they can also go out there and raise that much money with just an idea. The reality is that a lot of those people that can raise that much money with just an idea or just a product usually have really good networks that are capable to back them without ever needing to see a pitch deck. And if you don't have rich uncles and aunties and friends and colleagues that will be able to write you that much money without ever having a business put together, then you should probably go out and look for customers. So when do you need to start looking for funding? When you have enough customers and you're looking to scale. Not even scale, like when you have at least some amount of customers. I like to say a minimum viable product, and at least, in my personal opinion, at least $1,000 to $5,000 in monthly recurring revenue.
All right. Okay. I think that answers the next question as well, which is around like, I would like to ask, what do early stage investors look for in pre-revenue startups? So I think Eunice, you're off the table because you will not do pre-revenue.
Yeah.
But Dayo,
Yeah,
you guys do pre-revenue, and what do you look out for?
Just to add to that, we most of the companies that we've invested in have had revenue. I think there've been some exception to that as well. It's also an exception, is never the rule for us anyways, is for you to have an MVP and for the market to have reacted to your startup, right? And what does that mean? It could mean your beta, putting out your beta testing or private testing or whatever, and getting some form of reaction from the markets. And that reaction could just be usage. That reaction could be revenue. That reaction could be closing a particular client. That reaction could be anything, whatever it is, right? We want to make sure that your product has gotten into the markets. For those that are pre-revenue, I think the key thing I'll be looking out for is, how fast are you building this product, right? How quick are you building that product? And which is the same for pre-revenue and for revenue as well. But how quick are you building the product? Because I want to be sure that you can execute fast, right? I want to be sure you're spending your time full-time on this, not a part-time job. This is meant to be a full-time job, right? I want to see, if you're a B2B company, I want to see that you have closed some clients, or you have like an EOI, or you have like you have some form of document that tells me that you're closing clients. When you close those clients and when you launch your products, then those clients become your real clients, right? But it's very tough to invest in a pre-revenue. I would advise that you go to an incubator if you're pre-revenue, to give you some form of cushion. And when you get to a point where you've made your first dollar, even if it's just $1, then you can approach an investor that is looking for post-revenue startups.
All right. Question for you, Eunice. If someone applies to Ajim, how long does it take to hear back? Someone is saying they're waiting for a response, but it's been 3 weeks.
Yeah, I mean, on average, we want to get back to people within 10 business days. But to be quite frank, we have so much. We're like 150 applications back right now. So we'll try to get back to everybody as soon as possible. And like Dayo mentioned, the best person to reach out to us on our team is Calvin. And it's actually very harder to get me on a call or via email.
Awesome. Okay, we're going to round it up now. But I said that we'll have a closing question for all of you. And so this is now, hallelujah, I've gotten the check. We're up all night to get funding. Funding is in. Like the startup that Yewande wrote the check for yesterday, they're good to go. How should a startup be thinking about post-check? I've recently gotten a check now. How do I get the most value from this investor that I now have a relationship with? So what would be one advice you give to founders when they secure their check to make the most of that relationship that they now have with our investor?
Yeah, I can go first. I think if you've received money from an investor, let me say this first. First of all, like, the duty of an investor to you was to give you that check. And as long as the investor doesn't do anything wrong to prevent you from succeeding, they've done their barest minimum. However, as an investor, I obviously want to see you succeed. And so beyond just writing you a check, I'm going to do everything within my power to make the journey less difficult, because the journey is difficult, right? It's not going to be easy. I think the work starts when you invest, and there are a couple of things that we can talk about. You want to make sure that you're communicating constantly with your investor, either through investor updates or just even informal talks and chats, right? And just letting them know exactly how the business is doing. I would also say milk that relationship. There's a reason why they invested in your company. There's a reason why you felt having Ajim or Microtraction or HoaQ as an investor would 10x or 5x wherever you are. And so don't just sit there and not tell your investor what you need. Ask questions. They're always there to help. Nobody feeds a closed mouth. And so if you don't ask, the investor will not be able to help as well. So milk the relationship very well. And I think the like I said, the first thing is just make sure you're in constant communication, because I think that's super important.
I'm gonna go and say something quickly. I think like founders neglect like monthly report or monthly updates. I'm like, that's a bare minimum. You can send after somebody has written you a check. What you don't understand is that like investment is a whole ecosystem and a whole cycle, right? From the startup founder, many of them send quarterly. I actually think as a startup founder, when you're still at the pre-seed and seed, you should be sending monthly updates, because that helps me send out my updates, my investors quarterly updates. And a lot of the times my investors also have investors above them. And if I can't tell them how you're doing and they don't have an idea of like how our portfolios are doing, it's just a bad game for all of us. So I've actually found myself, when I speak to founders and I really like them, now what I do is I actually wait, and it's just a personal opinion given the current market. I want to see your updates at least a couple of months, see how you report to investors. And if you're one of those founders that never send updates, you only send an update one every 6 months or once a year, I am not interested, because I can't help you if I don't know how you're doing.
All right, Yewande?
Yeah, constant updates is the bare minimum from startups. I think for startups, leverage your investors' network as well. Like as little as, oh, we're having an issue on media. How do you think we should do that? They have PR experts they can reach out to hiring. I mean, at HoaQ, we do that very well. We have a very, very diverse network. To even regulatory issues, to you name it. Like sometimes investors can be available on WhatsApp to have just jump on a quick call. Some investors have office hours. Some give perks, AWS perks, different things. Some will invite you for events that will help you get more customers. But you can't tap into that if you don't share investor updates, or you don't communicate, or you go to investors for 6 months or 1 year, then you come back and say your wrong ways. It doesn't work that way. So leverage your investors network. They know a lot of people. They put in a lot of work to network on your behalf. And if you don't ask them, they won't know. I mean, they will check in on you, but it's better for you to just leverage and just reach out. I think that's my own summary. And yes, Nubi, someone's asking about Paystack Catalyst.
Yes, I'll do that right up with that. But I want to say thank you. I know Eunice is about to drop off, so thank you, Eunice, for joining the conversation. Please check out Ajim Capital. And reach out to the analysts and they're writing checks. Thank you, Eunice. Right. We'll come to the end of the webinar, and I was just going to answer the last question around the Paystack Catalyst around is it for only venture-backed startups? And as I know, like it's open to all startups. We have offerings within Catalyst that is geared for venture-backed startups. So yes, there's some things within the buffet, if you will, that are geared towards that, but we have other content office hours, perks as well, events and other benefits that also get to non-venture backed startups. And with events like this as well, like we want you to be venture backed as well. So we want to actually help you connect to investors, help you with your fundraising as well, get into accelerators as well. So you can even benefit more from the Catalyst program. But again, long and short, it's open to all startups. But yes, we have some elements in there that is actually geared towards venture backed startups, because again, they're thinking differently. It's more about growth and the likes. And we want to make sure, again, we're not doing a brush stroke value for everyone. Like we're actually customizing what people need to where they are. And so I think we have we've plugged in that again. If you want to learn more about Paystack Catalyst, there's a blog post there. Please check it out. If you want to reach out to the team, we are at startups@paystack.com. You can also go to paystack.com/startups. You'll be able to fill the form, tell us what we can help you with. We try to be very consultative in approach. So let us know what you need help with, be as specific as possible, and we'll be sure to get back to you ASAP. But again, thanks for our speakers, Eunice, Dayo, Yewande, and Tax Toba, and Dapo for opening the call as well. We hope it has been valuable to you. We hope to see you in our next event. But with that, thank you, and we're signing out.